All right. So thanks everyone for joining. I'll continue to let people in as they jump in, but we're 6 minutes into the evening. We start this on the second Tuesday of every month at 7 p.m. Central. So 7 p.m. Central, I do these live webinars. We do record them and then edit them, and then I post them to my YouTube channel. You can always find them at you can just type in Lee Fjord or Green Forest Capital, or you'll be able to find me on there and past recordings that we've done. We've been doing these for quite a while. Took a little break for several months, but bringing it back again. Kind of missed the webinar aspect of all of this, and thought it would be a great opportunity to be able to relaunch the webinars. So yeah, all right, we'll keep letting people in. All right, so tonight, the subject matter, and by the way, if things pop up, you can always ask questions along the way, raise hands, throw messages into the chat. Definitely introduce yourself. This is an interactive webinar. This is not just me up on some stage or whatever alone, like presenting. This is interactive. So ask questions, interrupt, and I will beeline towards whatever the night comes with. But the tonight's subject of focus is the real numbers behind a multifamily deal. I would imagine you're probably thinking like, oh, Lee's going to teach us how to underwrite an apartment complex. Well, we're going to cover the underwriting. We're going to cover the detailed, very deep. I don't even know how many. I think it's like a 12 tab spreadsheet that we use for our underwriting of all of our larger multifamily deals. But we're also going to cover the KPI tracker that we use to asset manage our deals as well. And then we will also go over and cover how we source the demographics for the properties when we're doing our initial underwriting. So yeah, we're covering all that tonight. I would imagine one or the other of them will kind of dive in even deeper as we go along, as there's more questions along the way. So underwriting, asset management, KPI tracking, and demographics all in one. So who am I? My name is Lee Fjord. I founded Green Forest Capital back in 2019. We now own a little over $80 million worth of real estate across 4 states, and also run a thought leadership platform called Make It Happen Multifamily. We not only do the live webinars that we're doing here once a month that you're a part of right now, but we also do our live events in St. Louis, Tours and Pours. And yes, Tours and Pours is this week on Thursday. So if you haven't RSVP'd for Tours and Pours yet, please RSVP to Tours and Pours. So yeah, started out as a property manager in 2012. Now we're building out a vertically integrated property management company. So we are now self-managing some of our assets. The most recent property that we purchased, we are self-managing. Actually, the last 2 in a row that we purchased, we're self-managing. So really excited about the progress of the growth of our company. So, just some basics, get prime the pump here. The basics are the benefits of investing in multifamily. Why do we want to buy larger commercial multifamily properties as opposed to single family houses? Well, it's a much more stable asset. If one tenant moves out of a 100-unit apartment complex, you're still 99% occupied. If you have a single family house and one tenant moves out, you're 100% vacant. So it is much more stable. You've got economies of scale. Because they're all the same, you can buy 100 faucets for a lot cheaper price. Is just one example of 1,000. You can increase the value of the property through forcing appreciation, through decreasing expenses and increasing the income, expanding the NOI, and utilizing the cap rate valuations that commercial real estate uses to increase or to determine the commercial value of a property. So you actually can affect the value of your property versus your neighbor selling their house for a lot less, and now your house went down in value. You can incorporate professional property management and hire professional on-site property managers to actually manage your properties so you don't have somebody like roaming around the city all day long spending gas money and whatever going back and forth. So it's a much better way to reduce your risk as a whole. It also gives me great opportunity to do business with some really cool people. These are some of my business partners here on standing out front right after closing of two deals that we closed back in 2023. We're going to cover some of the details of this one in Atlanta, but we're going to talk about the deal that we most recently closed in Warrensburg back in month. So we're going to talk about underwriting and asset management tracking. And I figured also I'd dive into some demographics for us as well. All right. So before we talk about like the numbers, I kind of want to give you a basic grasp of what we look for. We're looking for larger apartment complexes, 60, ideally 100 units or larger. We want to be buying them in areas that are growing. Population growth is extremely important. We want to be buying properties that are in areas that have a diverse economy, multiple employers all in one place. We're going to take advantage of the high level metrics. We're going to utilize internal rate of return, the cash on cash return, and equity multiple as factors to be able to make our financial decisions. And then, how do passive investors make money? Well, we're going to find out about that as well. And that's really what makes it us determine whether or not a deal is worth it to continue to move forward. If it doesn't pass these tests of our requirements, then it's not worth it. We have to offer a lower price or, move the deal in one way, shape, or form or another. So we pulled this straight from the OM of a previous deal that we just closed, and this is the deal we're going to actually run the underwriting for. So just kind of take note of a few of the aspects of the property. It's 64 units. It's got an average in-place rent of 1121. It was built in 2004. It's got great occupancy. It's got brand new roofs. It's in a good location to schools, lots of good employers. They're all electric and there's plenty of parking. So it checked a lot of those boxes. You're going to see a lot of these numbers reiterated in the underwriting we're going to cover here in just a few minutes. We've got our purchase price. Like, how did we get to that number? 117 units, it seems like a really weird number to be offering on a property. And yes, why we offer ultimately $7,525,500? How did we get to our equity multiple of 2.9? Where did our CapEx budget come from? Of $550,000 and, some demographic numbers. Like, where did we figure out where this median household income number came from? And where did the average annual return come from of 19%? And where did we figure out that we only needed to raise $2 million to buy this property? So this is the property in question. It's called Main Street in Warrensburg, Missouri. We closed on this on, I think it was July 9th. I might be a little off on that. But yeah, great property, very highly occupied in a great, municipality about 45 minutes outside of Kansas City. These are easy units to maintain as they are newer and well kept. So CapEx numbers, we're going to see this more detailed in the underwriting, but we've got interior renovations. We've got a budget for replacing HVAC systems, and we've got some storage lockers here that we're going to build out in what used to be an indoor pool. That's how we get to our $550,000 budget. We're going to show you where, and then in these individual units under the remodel, we broke down each one individually, like painting and texture. Well, I know that painting an apartment is usually about $1.25 a square foot to get a two-tone paint scheme. That's kind of a general rule of thumb. So for an 1,100 square foot apartment, I think it's actually, it's 1,100. It's going to cost you around $1,400 to paint out that apartment. It's going to be about $3 a square foot approximately to replace flooring. That includes vinyl and carpet. We do carpet in the bedrooms. So most of the time on the second floor units, we do carpet in the living rooms as well in order to maintain a sound barrier there. appliances as needed in this particular apartment complex. We budget for every little line item, even, trim carpentry and electrical fixtures. All right, we had to go through during our underwriting process and kind of figure out what do we want to do to this place. And that's what drove our business plan for the property upgrades. And then ultimately our budget that we set, for those upgrades. All right, so this is the investor returns model that we built out and developed after we underwrote the property. Essentially, the business plan for our investors is that they invest their capital. We cash flow along the way for 3 to 4 years, and then we refinance the property, returning 100% of their original investment back to them in a non-taxable event. I love this business model. This is the second time we've done a deal like this, and it offers this. This is the best part about these types of deals, is it offers the investors the opportunity to take their money and redeploy it without selling the asset. We keep the property. You get to redeploy your money in a non-taxable event. So basically you get to double dip. Cash flow along the way, and then we sell it, yielding a nice big fat additional paycheck to the investor. All right, sources and uses is the bottom line. It's how much are you borrowing? How much are you and where are you getting your equity? How much is coming from the partners who are actually doing the work? How much is actually coming from the partners who are passive investors? And purchase price, closing costs, fees, capex, and reserves. Each number has to add up to each other. So that's kind of how sources and uses work. I left this slide in because I wanted to give you a good idea about where the property is located. We're about an hour southeast of Kansas City. So you take from downtown Kansas City, I-70 over, and then you jump down to Warrensburg. Warrensburg is where the University of Central Missouri is located. There's about 30,000 people who live there, and it's located about 12 miles away from Whiteman Air Force Base. It's where the B-2 bombers are located. All right, yeah, 35. So, kind of running through this quick because we're actually going to see where I get the numbers from later. Just kind of referencing this. So, like 34,560 people live in this area. And how many people are renter occupied versus owner occupied? Where do we find these numbers? The short answer is in CoStar. I pay about $550 a month every month for that tool in order to be able to have unlimited access to CoStar nationwide. So then I can be able to pull demographic information, pull rent comps and similar data from there in order to be able to give a detailed underwriting and final look at our deals when we have them in the underwriting process, in the offer process. All right. So 2.9 equity multiple, 19 IRR or ARR, 21 IRR. This cash on cash is 7.6 and a 10-year hold, and we did have a minimum on our investment. All right, so who's ready to review the underwriting? All right, so we'll come back to this here in a little bit, but Main Street, here it is. All right, can everybody see my screen still? Is it like over here? Is that how it is? It's like that on your screen? That's the way it looks? Okay, cool. Just want to make sure. It's supposed to be that way. So we use a very widely, I don't know, used spreadsheet, a syndicated deal analyzer, originally developed by Michael Blank. We have taken that and we have modified it in our liking to incorporate additional tabs like CapEx and rent comps and things like that. But we took their basic spreadsheet, which basic is very detailed, and we then modified it, adding several other aspects of it as well and tying it all into one. So how we approach it is we start with VOM, the numbers that the broker provides on their basic offering memorandum. What are they asking for the property? How many units is it? And how we work through the underwriting process is we fill in the blue boxes, the blue words or blue letters or numbers, whatever. We fill in those and we generally try not to adjust the black ones because those are hard-coded cells with formulas that we don't want to modify because once we start modifying the code in the spreadsheet or the algorithm, or not algorithm, the numbers, it ends up breaking the spreadsheet. So we want to only really mess with the blue numbers. So we'll plug in those. Sometimes we'll kind of skip past this. Like on this one, we didn't really bother with that because we just jumped right into how is the seller currently performing? So we do T3, or trailing 3-month income. Because I don't really know, because a lot of times the reason why we don't do T12 income is because if a seller was getting, call it $1,000 rent in, call it this to January, and now it's September, and they have since renewed that tenant and they're charging $1,200 per month. Well, we're not going to revert back to last year's numbers. Like the income's probably not going to go down, at least not unless you adjust occupancy, which we will do. So that's why we do T3 income, and we do 12-month T12 expenses. So offer price, eventually we get to, and we adjust this number along the way constantly. We knew that our lender would be willing to lend to us as long as we have at least a 1.25 debt service coverage ratio on the property, that they would lend to us at 20% down on the purchase. We also know, because we've got a good relationship with our lender, that they are going to be willing to do an interest-only period with us of 24 months. So we did 24 months IO. Eventually, we worked through our CapEx tab and got to this number here. So as you can tell, this equals this number comes from our CapEx tab. And we always do an operating reserve equal to $1,000 per unit. The average in place rent. So we take the rent roll, we end up, adding it all up right here. Boom. And we plug in the in place rents. And that gives us what the in place rent average is, the weighted average. So this is the weighted average of the units in place. Then you have gross potential rent, which is just really all that added up over 12 months. Because it's their actual income, we don't have vacancy on top of that unless they are showing like gross potential rent and a vacancy factor in there as well. So if they didn't and don't, and they have to have cash books, then we just throw in 0 for vacancy. All right, other income. We plug in all of their numbers that they provide us in their T12. We get this big, long, individual spreadsheet with 12 months in a row: January, February, March, April, May, June. And each month has their own individual expenses and or income numbers associated with it. So, but at the very end, you have a total. That's where these numbers get plugged in. Right? Now, we knew our banker would be well, at the time when we initially start underwriting, we usually spread a little higher. I think we were originally at like 7.25 interest rate on this particular deal. We didn't actually get to 6.6 until we knew that the lender was going to give us that term. Once we had the term sheet from our lender and we were locked into a rate, that's when we eventually adjusted this. But I think originally we were at like 7.25. And we always want to make sure that the debt service coverage ratio is at least 1.25. Now, if you base it on the seller's expenses and the seller's income, which the seller's expenses were pretty darn low. They were operating this at very thin margins at 27.79% expense ratio. And that's probably not how we're going to run it. But you plug in all the rest of the numbers like amortization. Eventually, you adjust your interest rate based on what your lender shows. And yeah, down at the bottom, you end up with a cap rate. So if they were to have sold at a cap rate of 7, the fair market value would have been 9 based on their expenses. Well, we're not going to run it the same way as they are. And usually when you acquire a property, certain things change, like insurance and taxes and other things as well. Like things that are out of your control do change. Always taxes. So the next stage in the underwriting process If it passes kind of this initial smell test, we're like, yeah, the returns look okay. And it doesn't seem too unrealistic. Then we will continue along the line, and we're going to throw in the same T3 income, but we're going to plug in our projected expenses, the numbers that we think that we're going to be on running this deal at. All right, so this basically stays the same, but our expenses are going to probably be a little higher. Let me scroll over to the right. All right, so advertising. Well, we know that our average advertising expenses, I mean, it's about $125 per unit at the end of the day. So our advertising budget that we underwrote to was $8,500 per year. Contract services, well, we dove into their numbers, and we actually found a few things that we would be able to tweak and reduce their contract services. They were paying, because they were remotely managing the property in many aspects, and we were going to locally manage. We found that there was going to be a couple places where we could tweak. Gas and electric, we found that at the end of the day, that number usually ends up generally staying the same. Our general administrative expenses are relatively low as well because we're vertically integrated. But our insurance is going to go up. Now, originally, I think we put in like 40,000 here, but we ended up going out and getting quotes. And then finally, just before closing, we got a final quote and it came in right at 27,000. But this number would have been much higher when we initially started underwriting the deal. Legal, we're probably going to be doing some evictions. That's enough to do, like, call it 6 evictions a year. So call it 10% of the property. So 6 evictions on 64 units, that's a pretty conservative number there. Especially in Warrensburg, Missouri. This is not like some C-class community. We actually hired a tax advisor to give us an estimate on what our property taxes would do in the first couple years of ownership, actually for the entire 10 years. And they gave us it cost several $100s. Gave us a detailed number of what we would be looking at for our taxes on this property. The number was a little bit lower than this, but we ended up just rolling it up to 47,000. Trash is going to be the same. It's a 12-month contract, and it's basically going to roll in and we're assuming that contract, so it's going to stay the same. Management fee, though, they were really undercutting the management. Like, they weren't spending quite enough on that. They didn't properly fully staff the property. So we wanted to incorporate a higher management fee so that we could spend more money on additional focus and payroll and bookkeeping and all the things that are on the back of the house for the property. All right. They were also very slim on their payroll. They only had like a part-time manager and part-time maintenance at this property. And we were going to have at least a full-time manager and a part-time maintenance guy. All right. R&M, repairs and maintenance. It's basically a newer property. So we believed, and we based it on another property of the same age and the amount per unit that we were spending. And we ended up landing on around $164 per unit on basic maintenance. They have turnover expense. This is the one thing that was like a red flag on their numbers. They had like 0 in turnover. Well, you're definitely spending money every time a tenant moves out of a property, right? Every time you have a tenant move out, you're going to spend, at least $500 to go there, clean the carpet, do some touch-up paint, that kind of thing. So we based this on another property of the same age that we own in a town called Park Hills. And the number that we had in comparison in an equal number was about $300 per unit, a little bit more. But we wanted it to be like a round number, so we just put in 20,000. Then we have water and sewer expense in there as well. That's basically going to stay the same. And there's no deposit to replacement reserves because this is not an agency loan. You don't have to do that. So our expenses are going to be about $60,000 more a year than theirs at the end of the day. So our expenses are quite a bit higher. And yes, our net operating income is actually projected to be, if we based on our expenses, and their T3 income is actually going to be, what is that? About $60,000 less than what they were showing that they're making, which they can show whatever they want, but what's really going to happen is what we're trying to predict. All right. So now we get into what our expenses are and our income. So now we incorporate the market rate rent and our rents that we believe we can hit on these apartments. So we then determine through research into other comparable properties in the community what we think we can rent these units for. And we ended up landing on $13.25 a month. There are units in this community that are renting for $1,500 per month, but this one doesn't have like some dope pool. Honestly, they don't even have dishwashers, quite honestly. But if you're getting 1,500 for the same 3-bed, 2-bath unit, 1,100 square foot, but all you have is a pool, I think that a $175 discount is probably going to fit. And surprisingly enough, yes, we are already hitting our rent objectives. So fill in all the numbers based on these just kind of move over from one to the other. But with our income, we've got our rents, and then we have our projected vacancy. We know that our vacancy is probably going to be a bit higher than the previous sellers because we're trying to push rents at renewal. We're trying to push rents and bring in new residents. So that's going to be a little disruptive. We're going to end up doing some turnover along the way. So we projected 8% vacancy, and then this number is loss to lease, and or concessions. And bad debt is when you don't when a tenant moves out and they leave you with any unpaid rents. So the majority of this 80,952 we incorporated towards loss to lease. So that would be like a portion of the difference between this 1,011,000 and 820,000. So you've got like their actual collected dollar amount. And then it's like, what do we think we could get if we had 100% of the people paying 100% of the time at 100% of the market rate rents? Well, that's not ever going to happen. So you have to take out some concessions. You have to take out some loss to lease and some bad debt out of there as well as vacancy. So really at the end of the day, their number of 820, which they were achieving on their T3 income, our number of 849 is only a difference of $30,000. So not even 5%, it's probably right at about 5.5%, 6% of that original number there. So we're not overextending ourselves. We're not trying to say like we're going to hit the moon. We're just going to have high vacancy and high concessions at the end of the day. Other income, we found that so we are going to be adding the storage lockers to this property. We have some other tricks up our sleeve as well, including we're in the final stages of negotiating a cable contract where we will actually be providing everyone with cable and internet at this property, paying one single bill around $37 per unit. And then we'll actually bill back to the residents a $65 bill. So we'll end up making that difference of about $23. So if you take 23 times 64 times the vacancy, and you also incorporate the storage units, we ended up with a number of about 10 grand. We figured we would end up being a little about 10 grand better than what they were doing. All right. So at the end of the day, once you incorporate all of those things, we believe we'll get to a net operating income actually still lower than what the seller was operating their property at. Still lower by $25,000. Because we have high vacancy, we have high expenses, we've got all of those other reasons why. We actually still think we'll probably do better than this, but that's what underwriting is for. You want to remain conservative. All right. So that would mean that based on our purchase price, which we adjusted to 75255, that we were going to be buying the property at an in-place 8 cap with our projected income, which is actually lower than what the seller's number was on net operating income. And yet still have a debt service coverage ratio of 1.53 as opposed to like the minimum, which is 1.25 or 1.25. So we've covered a lot. We haven't taken a break. My voice is getting hoarse. Who's got questions about this first stage of the underwriting process?
Template with us?
Sure.
Is that possible?
Yeah, I can. I have a blank version of it, and I can do that. Absolutely. Just shoot me an email or put your email in the chat, and I'll shoot it over.
Okay. And so it's better to do it as a T3 instead, right? Because you get
On
to look at it, you get to look at it more detailed from that aspect.
on income, yes, because you're not talking about old income numbers that would have changed since then.
And it would be like the last 3 months that just passed.
Yes, the closest 3 months to today. That's the ideal situation.
Okay.
Absolutely. Yeah.
Okay.
And I'm gonna. Who else? Got any more questions?
But you did, I'm sorry, I have another question.
Of course. You bet.
So you did, so I realized that in the T3 income and T12 expenses, you did
Mhm.
add a combination of some of it was 3 months and some was 12 months.
Yes. Uh, so you want to do expenses on a 12 month on the T12. That's what you want to do expenses on. But your T3 you annualize, if that makes sense. So you take the 3 months and you multiply by four.
Okay, okay, okay. So it'll all pretty much be like 12 months.
Yup.
Okay,
Exactly.
okay, let me write this down.
Yep. So you take your T3 income and then you multiply that by four. That's basically how you get to your T3 annualized income there. Yeah.
At what point in the process are you filling all this out? Like as soon as the deal like gets on your table and like gets on your radar, are you filling this out and you're figuring out what you could offer and
Yep, literally. This is the process for determining whether or not we want to even move forward with even having a conversation with the broker at all. Like I figure out what the pricing guidance is. That's usually so I get an email from the broker and it'll be like, we're launching this deal in Warrensburg. And I'll be like, great, Harry, what's the pricing guidance on the property? And then I determine how I'm going to get access to the T12 and the rent roll and the OM. So I'll either ask for it if there's not a deal room, or I'll then go in and sign the confidentiality agreement and I'll gain access to the deal room. And that's where you can download the T12, the rent roll, the OM, and any other pertinent documents that the broker's put together and is providing to all of the potential buyers.
so you get the information, you underwrite it, you figure out that it's a profitable deal for you, and then do you go find the money or are you like finding money at the same time while you're looking for a deal?
I'm always looking for friends with money. I'm always looking for friends with money because I don't want that. I prefer not to have a brand new relationship with an investor when I'm presenting a deal. Like, I don't want to have an investor like have a deal and be like, hey, do you want to give me money? And then be like, whoa, hey, we don't even know each other. Like that's
Yeah.
but I want to create the relationship ahead of time. I want to have this conversation multiple times. One of the reasons why I do these webinars is so that I can maintain and create new relationships with potential investors. Quite honestly, just to
So
tell.
once you got the deal, then you go to those relationships and then you be like, hey, this is the deal I have ready to go. And then you give them all the information.
Yep. I'll even reach out to my top 10 people when we are initiating an offer, and I will go through and jump on a quick call or a Zoom call with them. And I'll pull up the property, I'll pull up the underwriting, and I'll be like, this is where we're at. Like, how do you feel about it? And if all 10 are like, no, not interested in Flint, Michigan, Lee. Why are you trying to underwrite deals in Flint, Michigan? You can't drink the water there. And I'll be like, oh, trust me though, it's an 8 cap. And they'll be like, no, you know, or there's so many other reasons why. But if 9 out of 10 say, yeah, let me know when you have this thing under contract and you've, gone past the next stage in the deal process. And then I've got, some money available. And that's when you just start having those conversations. And none of it's serious. You have offering docs for them to sign and everything. Everything else is just a conversation until then. It doesn't have to be some big pitch.
Okay.
Okay.
Yeah. Thank you.
Yeah. Well,
Lee, would you mind speaking a little bit on how you go about, I guess, identifying those other income
mhm.
opportunities?
So they usually are identified in the OM, where in this property, they in the T12, this like 52,504.68, that number was in the T12 provided to us from the seller, like how much they're bringing in on other income. Now, when we either reviewed the OM or when we did our initial site visit, that's when you start kind of figuring out, okay, where can we try to do some tweaking? Where are there opportunities? Whether and it not isn't always just in rents. Other opportunities can be in like in Park Hills, where it's like they're paying all the utilities. We can just ask the tenants to take over the utilities and reduce that expense. What that's usually figured out during that like OM review or on-site visit. So like when we were on site at Warrensburg and we saw this big empty steel building that used to be an indoor pool, it was like, what are we gonna like? We gotta find something to do with this. And a light bulb went off and it was like storage. Because I kept seeing all these bikes and all this junk on the tenants' patios. And I was like, they need some storage. And they're probably going to be willing to pay a little bit more for it. So I think we budgeted like $20 per unit. And our plan is to build out the storage units and then just put a storage unit rental fee automatically non-negotiable onto their ledger. And that alone, eventually it's 64 units. What does that add up to? Ryan, you might be faster than the 64 times 20 times 12. We're at 15,000 just for that annually. And that's at 100% occupancy. So if you did like times 0.9 to take advantage of 10% vacancy, we're at 13,824. It's like I can probably get to 10 grand pretty easy. We just got to build these out pretty quick. Which we already have the plan sketched out and a bid coming in from the provider that's building the storage units. But instead of doing them right away, we're going to use that as a staging area for this awesome new plan that we have for putting in dishwashers. So we're actually going to be putting in dishwashers on 100% of the units. We figured out how to do it. We're really excited about it. But we're gonna need a staging area.
I have a question also.
Yeah.
Okay, so when you're looking at T12
Mm-hmm.
and it usually says other income, right?
Mm-hmm.
Is it safe to ask them, like when you speak to the broker, what does the other income represent?
Oh yeah,
Because
absolutely.
sometimes they don't have it.
So like let's see. It's probably in here. Probably moved it. Trying to find the old T12. Yeah, here we go. Yeah, here's one of the T12s that we received during the initial process. So let's see. Here's other income, and it breaks it all out by the different income types. So you've got like pet rent, monthly application fees. So we charge like I think $45 per application for application fees, late fees, month-to-month fee, short-term lease fee, admin fees. They were really big on admin fees, which we haven't really done before in the past, but we've actually started doing it and we kind of like it. Trash fee, which we kept all of those in place because that was actually part of the lease. Same with pest control and utility admin fees. Those were already part of leases. So we just kind of left those in place. But certain ones we reduce. So at the end of the day, the total 63,807.87. I think that's actually
So you guys are kind of doing better.
yes. So we did 52,505 and theirs showed 63,807. What I'm betting we did is we probably took out like all of these.
Admin
I think it
fees.
was like there were a couple of these things in here that it was like we're not gonna have this much of that. And it was like termination fees. Yeah, like we probably pulled 4 grand out for that. Here's another one. This one probably was what it was. Yeah. So I bet if you do like equals this minus, yeah, 54, 5, 2687. And we were at 52, 505. So we probably also pulled out, what's another thing we would have pulled out? We would have pulled out like not just termination, but maybe like some deposit forfeit fees, you know. You're probably not going to get as many of those. Plus, you usually end up plugging that in for actually that applies towards the cost of putting the unit back together most of the time. So, yeah.
Okay.
So most of the time, a decent T12 does break out other income. Not in the OM, usually not in the offering memorandum. So like, let's find this is the appraisal. Yeah. So like this is the broker. Oh no, this is our OM. Where's the broker OM? Broker.
I think it was right under.
Yeah, that's probably right.
No, Samuel.
Roll. That's it. Is this
I think you clicked yours again.
right? No, that's the same one. Ah, here, broker OM. There we go. This one at the bottom. All right. So in here, the broker OM, you have your like basic top line information. Where let's go there. Demo, market overview, Orangeburg, more demo, rent comps, financial analysis. All right. So yeah, they've got like their other income as just like a dollar amount here, right? And what's one thing that you notice about this other income number? Every single one of them is less than what we underwrote to. Every single one of them. Because they always overinflate the other income in order to try to convince you that the property is worth more than it really is. So this is the OM numbers are just kind of like a dumbed down version of the detailed T12 under like T12 numbers. This is where you figure out where the property is actually running and how well it's actually being run, and how profitable it is. You know, like sellers showing this is the NOI line. Yeah, $571,000 in net operating income up till January. That was their year to date. That was their full year, 2020, basically 2024 to January 2025. So yeah. And as you can tell, like, so what probably happened. So you have your like, that's why we underwrite to the T3 and not the T12. Is their NOI was only 571 annually. But if you take the T3 income and the T12 expenses, you're probably going to end up with a higher number. That's how you end up with this like their NOI of like 630. We had our projected numbers still to do worse than that, or was. All right. So next you've got the summary tab. The summary tab is essentially your business plan. It's where you plug in the numbers for like earnest money deposit. How much are you going to borrow for your CapEx? What rate is that going to be? Is there going to be IO? Do you have an acquisition fee that you are assessing to the deal? What's the split to the LPs? What is the preferred return? Is there an asset management or a capital transaction fee? And then once you plug all your numbers in everywhere else as well, what do the returns end up coming out to at the end of the day? And so we usually plug in those numbers and then we move on to the P&L. What you'll notice is that in the scenarios tab right here, it pulls from column L, from this our income or expenses, and it plugs it automatically in on an annual basis into this this first year. All right, so then those numbers are all going to match up in line. And it even tells you, are you paying any principal? What is your interest payments? And it's going to pre-calculate it and base it off of any increases you might be incorporating into your rents. So, yeah. So like in here, it populates from scenario 7. And then in your P&L, let's expand. All right, in here, these were hidden. In here, you're going to find your escalators, your annual expense and income escalators. It's like, okay, how much is advertising, gas, electric, all these things going to go up each year? And when do they go up and by how much? So you can automatically plug in like 3%. All right, so all these numbers plug in automatically, but then you want to check each one and make sure they allocate. And there's a reason why each one fills in. Like principal doesn't start paying until 24 months into the deal. Why? Because in our original scenario, we put in that we would have 24 months worth of IO. Tracking? All right, that's how it works. That's how it all ends up working into the spreadsheet. And at the bottom, we have the beautiful number of NOI and the number we can actually, sorry, NOI is here. Then we have principal and interest. Then we have our available cash flow to our investors or available total. Then you have asset management fees. And then you have how much the pref is due to the LPs based on how much you will end up needing to raise. And then how much is actually going to be available for distribution to the investors. So in this case, we project it to be at around 7.9%. And it also gives you debt service coverage ratio at the bottom as well. All right, so then in year 2, your rent escalator automatically increases the rent by 3% because you plugged in 3% here. What we do is we use a vacancy and concession loss to lease number, and then that we believe will hit, and then we reduce that over time. So we'll reduce our vacancy number based on having the property more stabilized. And then we'll reduce the amount of loss to lease on the property as well, slowly but surely over time, until we get to about 8% total economic vacancy, and we leave that alone. 8, 7, anything below that is going to be way too aggressive. You'd never want to be at 5% economic vacancy. You're never going to actually run a property that efficiently. It's just never going to happen. Even if you have a 200 unit, 300 unit apartment complex, never going to happen. You're going to have some months where you're at 90, and you have some months where you're at 97, but you're never going to be at 95 or 96 every single month forever. Any investors, if you're an LP and you see an investor that puts this number down to below 7, you run away. That's just never going to happen. They're never going to be able to run that property that efficiently. I don't care how good they are. All right. So you're going to find that certain numbers in our business plan adjust even higher than than the 3% across the board. Why is that? Why do I think my insurance is going to go from 27,000 to 55,000 in year 3? It's because at the refinance, we will now have to place new agency loan debt on the property, and it requires different type of insurance. So that insurance is going to be carrying higher limits with lower deductibles, and the value of the property will be assessed at replacement cost as opposed to, what's the other one? I forget. It's we only really do a replacement cost, but it's I don't know, cost plus or cost basis, I think maybe. Anyways, but this same insurance is not going to work for an agency loan. We're putting an agency loan on the property. So our insurance, we basically said, is going to double. Our insurance is going to double when we put a new loan on it. And in that case, our expenses are going to grow a little bit more in that year. Wow, close this. I don't want to box. And net operating income is going to stabilize. We will also begin paying principal. We actually might not, though. If we refinance into an agency loan and that agency loan has It has no principal payment for the next 24 months, then we may not, and we'll actually hopefully be able to distribute this $105,000 out to the investors, ideally, which would then increase their overall cash on cash return. But it's still projected to be around 7. All right. Year 3, somewhere between year 3 and year 4, basically put this refinance somewhere in the middle because nothing ever happens like perfectly. It's always going to happen somewhere within a range or not at all. With certain deals, it never happens. They just never are able to fully execute their business plan. But that's not our intention. So, we will throw a loan on the property. We'll return back to the investors their money 100%. And how do we know and when do we adjust that? So we adjust that based on the exit strategy tab. So, well, actually, let's move in acquisition costs because acquisition costs is going to be the next part of it. So, you have your legal expense, your property inspection expense. This we actually dialed in after the fact. We have a standard of putting in about $200 per unit on property inspection expense. But actually, after we spend the money and we've actually gotten closer to closing, we'll actually put in basically the same dollar amount that we truly spent by the end of this. Because please remember, this is the underwriting of the actual deal that we ended up closing. Yeah. And any expenses associated. So we like environmental inspection that we did, paid for an appraisal, our structural inspection. We had an origination fee of only 0.5%. Yes, they are negotiable. All of these different expenses associated with the property, including the prorated period of taxes, as well as the insurance prorated for about half a year based on the closing date. So your exit strategy, you're going to be able to adjust when do you cash out your refinance and when do you have a sale. It doesn't allow you to go past 10 years, but you can do so like that will help us determine. We adjust that to tell you what it's going to end up being here. So let's say, what would it look like if we only did the refinance in year 2? Well, the investors at 24 months would only get 93% of their money back. We're not in the business of giving back 93%. We're in the business of giving back 100%. So it's like, okay, we'll have to at least say 3 years, which probably means 36 months to 48 months because it's like the third, it's like the 36 to 40 month time frame. Yeah. It'll automatically calculate the additional proceeds, appreciation, or any of that for us. I love spreadsheets. It's a beautiful thing. And then this is how it calculates. It pulls net operating income from the 10-year P&L. Right. 864, 455, 2, 864, 452. Exit strategy, 864, 452. So that's where it gets that number. And then you plug in a cap rate, sale price, market valuation. I generally go, it depends on the age of the property. Like if it's a 1970s property in a C-class neighborhood, this better start with an 8 at minimum. At minimum 8 or 9. I'm selling a 9 cap property that I always thought would be a better one, but I'm selling it at a 9 cap in a C-class neighborhood right now. And I'm still happy with the sale. I'm getting the number that I wanted at the end of the day. Good enough. Could have been better, but it's okay. So everything could always be better. But it even calculates, sale costs and all that. So, and then eventually the total return cash to members. So all of these numbers you'll notice are parts of our offering memorandum. So you have like those are demos. The returns, right? So you got like 100, 60, 40, 95.05, 72.89. Turns. Okay. Member returns. So you got your 100, 79.09, 10.90, 74.42. Now, why are these a little bit different? It's because we locked in our spreadsheet when we did our underwriting and when we put together our OM. We have our investor OM or investor underwriting. This is our actual final underwriting. It's a living, breathing document, and it changes all the time, constantly making tweaks to it along the way. But we lock in versions of it, usually on an annual basis. Right. Yeah, you incorporated a rent comps tab that wasn't existing in the previous Michael Blank version. It gives us the information about the similar comparable properties in the municipality in a single spreadsheet. We also have a Cap X tab that's not part of the original Michael Blank spreadsheet. So we have our storage units. So we have like a section here for exterior renovations and then like unit upgrades, right? So we intend to do add the storage units to the property. We think it's going to cost about $50,000. We budgeted $75,000 for our HVAC replacements. We've got a $6,750 budget for our only 1-bedroom and a $9,000 budget for our 3-bedroom. Now you can determine how many units you plan on renovating. No, we don't plan on renovating 100% of the units. Why? Because the seller already did that. They already renovated like 20 some odd of the units. In fact, after we did our final or our inspection, we did basically determine that we'll be surprised if we end up fully renovating even like 30 units, but we still left the numbers alone. That's just more cushion and or less bank loan debt that we have to take for our take from our lender. So less interest we have to pay, and less we have to pay back. All right. Any questions along the way so far? No? All right. Let's
Yes, I do. Where do you
go
get
ahead.
those numbers from?
I get those numbers from after doing a site visit and then generally knowing what they are from my experience at this point. For someone that's newer, they would want to have an estimate from either an experienced property management company or experienced general contractor.
Having fun up there?
We're gonna need your help.
With what? You have to get the thing.
All right. So, we're gonna keep moving here. All right. So this is something that a lot of that your lender is going to want to see when you bring the deal to them. They're going to want to see a P12. Can anybody guess what P12 means?
Predictions?
Predicted 12 months. So what's the first 12 months going to look like and how do you get to those numbers? So, and does it match up to what your actual first year is going to look like? So we then break out what the first month, second month, third month, the fourth month, and all the way to the first 12-month ownership is going to look like. And we also have a section where we plug in how many leases are coming up for expiration. How many units do we think we're going to have to, how many are going to end up being turned, like new tenant placed in that unit? And then how much are we going to have to spend in order to get there? And that helps us determine what our budget is for capital expenditures on unit turns, as well as our vacancy. It'll end up because we're going to have a predicted number of units that end up moving out. So you have like 4 units that are coming up for lease expiration, and we have 2 units that we think we're going to have to turn. 5 and 3, 4 and 2. So we basically are underwriting to like a 50% turnover ratio, which is about right. Yeah, 50%. Hopefully it's less because vacancy is expensive. But we estimated 52 that 32 of the 64 units were going to end up moving out and having to replace those residents. So any lender is going to want to see a P12. You're going to want to break out your monthly expenses for each single one of those things and then provide it to your lender. All right, let's go back to this. Where are we supposed to go on from here? I guess we can go on to demographics. or we can do who wants to do demographics, or who wants to do KPIs.
API.
Right. KPIs. So what do we look for? This is our KPI tracker that we built out for all of our properties. We use a single KPI tracker that then we add or remove certain aspects because every certain property has a certain different thing that you're going to want to be tracking on a weekly basis, not monthly, weekly. So when we first bought, and the main thing that we look for, like obviously you want your occupancy, your leased occupancy, which is like how many are you leased to. So if you're pre-leased, it's going to be higher, so on and so forth. And then vacants, rent ready units, that's number of units that are actually ready for a tenant to move in. How many units are in progress? Those are units that are not move-in ready, but are in some sort of queue for the process. So when we first bought the property, it was at 96%. And then we had a few tenants move out at the end of July. So we got down to 85.9. By the end of August, we got to 92. But then we had a couple tenants move out. So man, okay. Or actually, and then so we had dropped down to 96 or 90.6. All right, so we're constantly, every single week, we have a weekly meeting with our property manager where we review each and every aspect of these things. Like how many evictions do we have going on right now? How many applications did we receive? How many leads did we get? Guest cards are leads. Those are like active leads that are actually starting communication. We don't count how many people click like, can I get more information? We count how many people interact with us on a weekly basis. This number feels really low at 4. I feel like that Brian's plugging in the wrong number there because it should be higher. But yeah, delinquency, that's something we're always monitoring. Like especially this 31 day. If you get past 30 days and you owe me money, guess what? You're not going to be living there for very long. So if this number at the end of the month is higher than 0, Lee is not happy at all because you are going to not be living there for very long. All right. So work orders is another thing we track every single week. How many work orders are there? We never want to see more than 10 work orders. Because work orders mean upset residents. That means you have tenants who are not happy because something is not being fixed at their property. So we don't ever like to see more than 10 residents that have a work order in one of their units at all times. And we actually, open work orders at this property right now, we only have 4, and we completed 7. So we also count how many work orders are we getting taken care of in a given week. Is the maintenance guy actually doing his job or not? And we also even monitor our Google review score and how many total Google reviews we have, and what is our in-place rent. So when we originally bought the property, we were at 1145. This feels like a typo somehow, but now we're at 1146. So the average rent has ticked up just a little bit in place. So these aren't very exciting because we've only had the property for, about 2 months. But we also track monthly performance. We also track our rent guidelines, what the rents are that we are charging. And then every time we make a change to it, we add an additional layer to this where we see what changes have we made or what tweaks have we made to our rents? What fees are we adding on? So on and so forth. We also track our rent roll, like which one is in what process, how many have we renovated, so on and so forth in our rent roll. We also track our budget for unit turns, and then our exterior budget. Have we actually completed building out those storage cages or not? And if we did, how much did it cost us? So let's take a look at this one. We bought this property in November of 2023. This is Phoenix Place, now called Arrow 2420. So let's go all the way over to the right. When we bought this place, the average rent was $931. Now the in-place average rent is $12.78 2 years later. So we went from $9.31 to $12.78. And yes, it slowly but surely trickles up. But what happened at the property? Well, we bought it and it was right at about 90% occupancy. Actually, it was a little less because we had several people that just weren't paying. And all of those non-payers and all those residents that we didn't want living there, and as we were raising rents and as people were choosing just to not stay because it wasn't comfortable for them anymore, our occupancy dropped from in the 80s all the way down to 65%. That is just scary when you're that low. Scary, scary, scary. And then we started leasing up our units. And yes, we were still renovating units and leasing units as we were falling in occupancy. And we found this base, right? Where we kept as many of the residents as we possibly could. We placed as many of the residents we possibly could. And right at around 6 months into owning the deal, we flatlined and found the base bottom at 65% occupancy. And then we began climbing as we kept residents happy and as we kept renewing the existing residents that we were keeping and that we were already happy to keep there at the property. And now I'm glad to say that we are sitting at 94% occupancy. Talk about a roller coaster ride. That was a lot of work. Oh my God. And take a look at this delinquency number here, right? So this is the number we want to see. We want to see rents going up, in place average rents climbing. And we want to see our delinquency falling. At one point in time, on a given week, we had, well, this probably doesn't count because it was probably like the first week of the month. But we had, even at the last week of the month, we still had around $150,000 in uncollected rents. Crazy. People just weren't paying. Atlanta is a hard market. And we managed to get them all the way down to here. And then recently, we've been pushing for our occupancy. This is this final push here, right? So we found like in the 80s, and then we really tried to push occupancy. So what did we end up getting? We ended up getting some like undesirable tenants in that process. Some of our tenants in the middle kind of shifted out, stopped paying. So our delinquency has started climbing. And how we know to watch this is because we track it every single week. Creates red flags. You're like, oh, this isn't good. We need to do something about this right now. This trend is not, I'm not happy with this trend. Our delinquency and our 0 to 30-day delinquency and our total delinquency is all trending in the wrong direction. We're going to do something about this. This is another fun one here that I like to look at. At one point in time, we had active evictions. We had over 30 active evictions at this property because we had $150,000 in uncollected rent. It was crazy. So we evicted, I don't have the total number of people that we have actually evicted at the property, but it's probably 40. It's probably 40, 45, 50 at the end of the day. Total people that we ended up having to evict out of a 144 unit apartment complex. So, but our expected evictions, as you can tell, has been starting to climb as we have people who surpass that 30-day period. And that's how you have expected evictions. Expected evictions are people who haven't paid all of their rent by the 31st of the month and roll into the next month and owe me money for the following. So you can also tell when we rebranded the property. So we went from 150 total Google reviews to rebranding the property. We started back over from 0 in January of 24. Yeah. So yeah, that is probably right about here as well, because we went from where we were 4 to 5 and then kind of creeping into that back into that 4 range. I'd like to see that more at like 4.4, 4.5. So yeah, we also track monthly performance, monthly totals, which also include our expenses, our monthly our adjustments to rent guidelines, so our market rate rents, like what we advertise on our website. We track lease swaps, like all of the leases that expire and how much we increases those rents by, how many units we've renovated at the property and what kind of unit are they now, all the way to how much did we spend on those units and how much were we over or under budget on those. What projects did we get taken care of and how much did they actually cost us? So originally we had a budget of 975. We spent 917. And then our unit term budget tracker, we kept that in place to kind of compare to what we were spending on our unit turns. So yeah. And then we also monitor and manage our budgets through this same spreadsheet. So that's how we track KPIs of a property. This, of course, this property has been held for two plus years now. Well, actually just shy of 2 years. And was a very intense project that took months and months and months to stabilize. And I'm hoping that this one looks much different. That this just kind of looks nice, slow, and steady. All right, we're an hour and a half in. Is everybody bored and tired of listening to Lee talk?
No,
Not at
at
all.
least I'm not though.
I'm not either.
All right. Let me know when you get bored. We're coming up on the time, but I will show you kind of where I get the demographics for the properties. This CoStar, it's a tool that I pay for in order to be able to have access to information. You can too. It's about $550 a month. Is it worth it? It's worth it if you're closing deals. If you're not closing deals, I wouldn't pay. It's a really expensive tool. Or maybe you're a broker. Yeah. So this is where we find, like, for example, the details of the number of units, what the market rate vacancy is in the area. It has details about the actual property itself, like gross buildable square feet, how many buildings there are, how many units, so on and so forth. I don't know how they got my exact number. I didn't tell them what my number is. All right. What county is it in? So all of this detailed information. Is it in a floodplain? The units. How many individual units? What type? How many square foot? Usually you don't have lease information unless it's like commercial property. Comps. So in here you can be able to source rent comps around the community based on comparable other properties in the area. So for example, you got our property versus Meadow Estates. Let's see. Meadow Estates was built in 1974. It's 73 units. The average square foot is 892. It's probably not really a comp, but yet they're still getting better rent per square foot than we are, than 1254. They don't have any 3 beds. Actually, sorry, they do. They have a 3 bed they're getting $12.99 for. That's a pretty decent comp. So I'm gonna really look for those certified radius comps, and I'm gonna change my comps based on whether or not they have 3 bedrooms and how many square feet. So you go around to the community and you pick different units or different properties that do or don't meet your criteria, or sometimes they don't even have any information, so you wouldn't want to add them in as a comp anyways. So we spend hours and hours picking which comps are the closest ones to our property, and that determines which one ends up being on this list. Analytics. All right, this tells us what, key metrics there are in the area. Like, what's the vacancy rate here? If that is like over 10%, you don't want to be buying here. You don't want to be buying in a place with over 10% vacancy. Low vacancy is a good thing. Market rate rents, and then what is it for your per unit? Market cap rate, sales volume, demand. You've got your population growth, which at the property doesn't really count. It's a very small market. So what we're going to end up, and all of these have like graphs that they tell you what's coming in the future. I like this one, demographics. So like within 10 miles of the property at 2020, there was 33,732. In 2024, there was 34,561. And by 2029, they predict that it's going to be over 35,000, or an annual population growth of 2.4%, 1.2%, and then within a 10-mile radius, 0.63%. And they predict that to continue to move in a positive direction for the community. If you go to like Flint, Michigan, that's probably negative like 10%. Certain areas of St. Louis is probably like negative 10% within a 2 or 3 mile radius. But certain areas of St. Louis have a positive population growth. So that's why we don't just base our decisions on like the macro market necessarily. Like we do want to know that we like the MSA, but we do make our primary choice of whether we want to buy the property on more like the local market. Are households growing? How many people are there? What's the median household income? So this number originally kind of scared us. 43,000. We were like, whoa, red flag. Hold on. Why is it so low? Bunch of poor people living here? I don't want to rent to poor people. They trash my apartments. Plus if Mac caps their rent. Let's just actually put it reverse that. I don't want to rent to poor people. I don't want to be capped on my rents. Where I want my people to be able to afford the rents that we are going to choose to charge. But why is it like that within 1 mile radius? Because it's literally next door to the college, and they take into consideration the incomes of college students and like grad students going to the college. So once we took that into consideration, as well as what who we were really trying to go after, we're going after these people that live within 5 and 10 miles. So we were like, okay, we can get more comfortable with this because these are the people that we're actually really trying to rent to, is the 57,000 plus people. And someone who's making $57,000 a year, we do a 3 times rent income. So you take 57,000, you divide it by 12, okay? And then you divide that by 3 because it's 3 times the monthly rent is the maximum or the minimum income they should earn. So someone who makes $57,000 a year can afford a $1,583 per month rent. So as long as the median is good and my rent that I'm projecting to be marketing to is lower than that, then I'm happy and I can continue to move forward. If it's a skew, you have to adjust. Now, if you're going for like a $5,000 rent, there's not that many people. So you're also going to want to look at how many people fall within your target area that are going to be able to afford your rent. If there was like 0 people making between 50 and 75,000 or 75 to 100,000, then we probably wouldn't want to go there. Certainly not buy a 64 unit apartment complex. Median household income. This helps us be able to determine things like whether or not what the affordability risk factor is. So if you are renting to regular folks, not students, which we don't do anyways at this property, probably they're mostly a lot of grad students, a lot of people who work at the college. But anyways, if the median house price was 50,000 and you're trying to get a $1,350 rent, well, the affordability skew would mean that it would be a lot cheaper for them to just go buy a house than it would be to rent from you, right? But if it's the exact opposite, they're more likely to rent, and you want that. So we did the math. I forget what it was exactly, but it was like we plug in a mortgage calculator, 192, and it automatically calculates what like taxes and insurance should be. And I want to say that this comes to something like $2,000 a month. If you want to live in a $200,000 house right now at today's interest rates, which is like 5.5 or whatever it is, you're probably having to pay quite a bit more, 50% more than what you can pay in order to rent a 3-bedroom, 2-bathroom apartment. Tracking? Make sense? Cool. So this is where we get all the information that we put into our investor presentation. Things like employment numbers, median household income, how many people rent, what's the population growth, median home value, and the median age. So that's where we sourced all the numbers for a multifamily deal. We've kind of taken questions along the way, but does anybody have any questions? Like to ask anything further before we continue to further on towards the end? All right, we'll keep going. So, who here is in St. Louis or willing to come visit this upcoming Thursday? Yeah, 2 days from now, we're doing tours and pours. here in St. Louis. We're going to be touring this awesome property that, yes, used to be a church and a what is it, mausoleum, or where the rectory, or where all the people lived who worked at the church. All that was converted into apartments. It's a super sick church converted property into these dope lofts in the Central West End of St. Louis. We'd love to have you out for tours and pours. If you're in the area, you can scan the QR code, and we'll see you there day after tomorrow, 6 p.m. at Sanctuary Lofts in Central West End. And then we go to Schlafly Tap Room and we interview the owner, and we will, allow everyone to ask questions like, how did Tim get so dope and buy, like, I think he has like a couple hundred really nice A-class apartments in St. Louis. All right. I also host or am a co-founder of an education group called Vision to Wealth Now. Yes, Vision to Wealth right now. And we host a regular workshop. Our upcoming workshop is going to be on October 18th and 19th, live in person here in St. Louis. It's a 2-day workshop for $250. You get to come spend 2 full days with me and Tom and learn about personal finance, how to invest your capital, how to be able to like little tips and tricks and fun things. I know Shelly was there. I know Ryan's done it before. What did you think? Did you have fun while doing the Vision and Wealth Now workshop?
Yes, I enjoyed it.
Perfect. That was the best raving review I've ever had.
Yeah, it was good. I've been to it twice, and yeah, both times were really beneficial. I think I took a lot from it.
Yeah,
Same.
Definitely
it's
recommend.
a great opportunity to immerse yourself in a room and just focus on setting goals, finding your vision, and narrowing it down to little tips and tricks and tactics you can take in order to achieve those goals. And if you'd like to get to know me better, you can scan the QR code and schedule a call on my Calendly at your convenience. Short get to know you, or just to catch up, or if you have additional questions and you were afraid to ask them today, scan the QR code, find me on greenforestcapital.com, and we will jump on a call and get to know each other. Regardless of whether you're interested in learning, more about me or what we do for passive investments, or willing to help and add value to anyone and everyone that I meet. So don't hesitate to schedule a call. Happy to do it. So with that being said, if anybody was ever interested in reaching out, let me know. And I hope you have a great evening. Thank you for attending live, or like tuning in if you're watching this on my YouTube channel. So if you're tuning in, then please like and subscribe. If you aren't and you are live, just go to the YouTube channel now and do it anyways. Just, like, and subscribe, because that's how people find more information about Green Forest Capital and Lee Fjord. Perfect. I am going to send you guys a copy of the spreadsheet here in just a minute, and or any other kind of stuff that you're interested in seeing. So I hope to hear from you, and we'll see you again next time. Thanks, everybody.
See you, Lee.
Thank
Have a good
you.
night.
Bye, guys.
Bye. Thank you.
My pleasure. See you.